Yeah. No, you want to do a summary, okay? After this, briefly.
Okay,
Just
Lauren
focus
goes, and
in.
then I'll do a two-minute summary, elevator
Right.
pitch. Okay.
Okay. So let's go, Lauren, and then we go with Trevor.
Perfect. So before I get started on the function savings policy simulation, I would just wanted to introduce the theory behind it. Essentially, the utility equation and the two conditions necessary are solved for within the program. So essentially, let's start off with a two-period consumption model where there's consumption in period T0 and then period T1. And this builds off of previous programs, including two-period consumption and two-period consumption 2. But we'll be focusing on adjusting certain parameters within the conditions. But in the meantime, we have this utility function, which we want to maximize, which is the log of C0 plus beta times the log of C1, where C0, once again, is consumption at time T0, C1 is consumption at time T1. And essentially, what this program does differently than two-period consumption and two-period consumption 2 is that it manipulates the certain values of whatchamacallit, manipulates taxation as well as the interest rate. Taxation is represented as T in my writing, or also known as tau. And then also you have beta, which essentially 1 minus beta ends up being the interest rate. So overall, the goal is to find C0 and C1 that maximizes utility given taxes and savings. Any questions here so far?
No.
Okay, perfect. I'll switch over to the code then. Let's see, stop share. And then I'm going to switch over to I'll just share my entire screen then. So here we have the function savings policy simulation. One of the key things that this does differently than what we've seen in class so far is that it includes a user interface, options that include sliders, essentially how we're going to manipulate the tau and the beta, that's the interest rate, is that we have different sliders now included. So first we have we create the user interface figure. It's here, figure user interface figure name, intertemporal policy simulator, position, and everything you see in line 3, line 6, line 9, line 10, sorry, in those brackets essentially determines where are these sliders going to be positioned. And since it's pretty repetitive, I'm just going to stick with one of them. So for example, line 6 and 7, line 6 defines the user interface label for tax rates, essentially where it'll be on the figure. And then tax slider then develops the slider itself, including for this figure, its position, the limits. We're going to go from 0 to 50, as well as set value of 20, which is what was previously done in two-period consumption and two-period consumption 2. I'm going to skip over the slider for the interest rate. All you'll need to know there is that we started with a beta of 0.95. So from there, we just get 1 minus beta, and that gets us our initial 5. And then from there, we also include code in line 20 to 22, which says, okay, MATLAB, I would like you to update my sliders from these values of 5 and 20 based on where I drag it. Any questions there so far? So the new parts here are essentially, we now have figures that are interactive within our figures and within our plotted figure, and how that'll eventually affect what our function will be in the next lines. So from there, you have the function is now function update plot is here. So essentially you have changes to the axis, changes to the tax slider and the R slider. And that essentially affects tau, like I mentioned, which is our tax rate, as well as R. The only difference with the tax rate is essentially we have it as whole numbers, so we just divide it by 100 here. So we have our model parameters. Once again, I'm going to briefly go back to the sheet just for you to see it one more time. We have max utility rate with log C0 plus beta log C1. And essentially C0 is defined by, we have 1 minus tau, or 1 minus our tax rate. Everything left over from that is our disposable income. And from there, we'll take our savings. And that essentially, our choice of savings, given our tax rate in C0, determines our consumption at time period, the next period, time period 1. So that's condition C1 equals 1 plus R times S. So just wanted to repeat that again, because I had to refer back and forth when reviewing this program myself. But if there's no questions here, I'm going to switch back over to the program. I believe that'll be the last time I'll do that. So we have beta as 0.95. We have our lower bound set and our upper bound set. We have our lower bound set at 0, our upper bound set as our 1 minus tau times I, or our disposable income.
Mhm.
And then we have utility at variable s. So essentially we're going to be minimizing, or we're going to be looking for our minimum value, I'll explain that shortly, of utility by multiplying with respect to s. So we multiply that log C1 plus beta times C1 times log C1 by -1 because of the idea that we can find the minimum value, and then at the end, once we get that minimum value, we'll multiply it by the negative again, having found our optimal savings to get our maximum value of utility in return, given our choice of savings. So from here, this is an optimization problem. We first start with opt S, where we do the minimum search. So this is not, I believe it's not by differentiating. I had to look this up online. But with respect to S, we want to minimize the utility function. And we have a starting value of S0, which was 40. And then from there, once we get that optimal S, we'll plug that into the next line of optimal S, which tries to find the maximum value between the minimum of optimum S from the previous line, the upper bound and the lower bound. That line, all you'll need to know essentially is that determines what the optimal S is and if it remains within the bounds that we've set.
Mhm.
And from there, since we started with income and tau, and the only thing that we really needed to search for was optimal S or optimal savings, we can just plug that right into opt C1 and opt C2. And then, like I mentioned previously, with the understanding that we have a minimum value at we get a minimum value and thus multiplying it again to get our maximum utility. That's what this line does here. And this was pretty neat. I plan to use this in my own project if it works out. Essentially, what lines 50 to 53 do is that we have C1 values. So essentially defining our X and Y axes and saying like, we're going to use capital C1 and capital C2 to essentially define over the 3D, over the surface of the plot. So define utility at all these different values. And then finally, 56 to 60 define, okay, how does the plot change based on what our values of tau or the optimal savings we've found, or what income we've set, or the tax rate. And then from there, it'll update with line 58, particularly identifying, okay, this is the optimal consumption at C1, which is time 0, and C2, which is time 1. And all this to say, if you run this program, your final result will be, let's see, I'm going to share that right here. Your final result will be this intertemporal policy simulator with the interactive sliders up here, ranging from, hopefully you can still see it. Yeah, for ranging from 0 to 50. And then you also have, I can manipulate it further. Let's say I want an interest rate. Let's say I don't value the, no, I won't I won't confuse myself with macro, because we did this when I was a TA. But essentially what this does is that it'll tell you, okay, with this tax rate, with this interest rate, this is the max utility. It's not reflecting on my end, but the long story short is you manipulate these rates, you're going to get a red dot here, and it'll tell you, okay, given this rate, given this tax, you'll get this amount of utility, and this will be your consumption at this time. Any questions? I hope that was recorded.
So where is my red dot there?
So the slider works on my end. It's just that I think it's sensitive because I'm
Oh.
sharing my screen.
So you see the red dot?
Yeah, I get it when I move it,
Oh,
but
got
it's
it.
just
Yeah,
not
yeah,
showing
yeah.
up when I do it for you guys.
Yeah, but that's good.
Yeah.
And
Yeah.
that's important, guys, because the red dot tells you basically what is your consumption 0 and consumption 1. And given the tax and the interest rate gives you the maximum utility function. Okay. So you're
Yes.
optimizing. This is called an intertemporal optimization.
Yes.
Good. Questions,
Yes.
guys? This program, I like this type of programs because it allows you to test and to do policy simulations, guys. When you do policy simulations, you want to have this stuff. When you talk with politicians, you say, let's move this stuff, let's move this stuff. They can see clearly what is going to be the result in their decisions. Make sense to everyone?
Yeah, I actually realized I had paused the code, so it should be visible now. For
Yes,
this
it
tax
is.
rate of 19%, interest rate 14, you get max U 7.33 U tiles,
Yeah.
and you consume the
41
X and Y
now.
your
Yeah.
consumption. Yeah.
Right. Perfect. Questions,
Great.
guys? Everyone, sorry, guys, at the end of the class, please send me the codes that you have worked with, okay? This is good. Perfect. So Trevor, you need to go back again to the game. You know,
Let's
2 or 3
go.
minutes maximum. Just focus on the ones that we said: string to sums, symbol, sim to poly, and easy plot, please.
Yes.
Just
Okay.
brief description. Yeah.
Yeah. So this profit maximizing, easy function here. Can read all it in the notes, but here we have revenue equals string to symbol. So this allows you to take a string and put it in this like symbol format where you can have variables and you can manipulate the variables. So you have this in the symbol format, and then you're able to take the derivative of those symbolic math. So if we run it, okay, I don't know why there's an error now, but basically it'll take the derivative of all of that. Try running it again. Okay, I don't know what's going on now. So string to symbol takes a string, puts it into like an equation basically, and then sim to poly. This will transform the equation with numbers. So then we will be able to plot it. And yeah, so take the symbol, put it in a poly, then it'll have numbers in it. So then you can see the graph of it. And then easy plot. Within easy plot, we can put in a poly and a range of numbers. Here we have 0 to 50, and it'll plot that function C from 0 to 50. And I don't know why there's an
I think
error
you need to
now.
just run, go up. In your MATLAB, there is
Yeah,
run up, just go up, because you don't have a function, right? You don't have input, so go run up,
run
up.
up,
Yeah, there is run, just click there.
just hit run.
Yeah,
No,
that's interesting.
save it. I don't know. It really worked. I didn't touch it, I don't think. So I don't know. Oh
Yeah,
wait, is there some? Uh,
no, you have done everything correct.
yeah,
It
since
ran before, it
it
ran
ran before,
before.
since your declares as Q, and then we
Yeah,
can use Q as the variable. I
yeah.
don't know. Yeah.
It doesn't matter at
So
this point.
doesn't
Let's go.
matter. Okay.
Yep.
And then
Do you
if
have
we
the
have
figure open or you close
no,
that?
I closed it. Maybe I don't know.
Okay, it
Yeah.
doesn't
All
matter.
right. But
Okay,
easy. It will work when you try it at home.
yes, definitely. Thank you, Trevor. Thank you, guys. Okay, so now we go with group number 2.
Yes.
Hey,
Let me,
Karina. Okay, so which one
I
are you gonna take?
I'm gonna
Right.
do the generate intertemporal app
Up.
and
Yep.
file.
Yep.
Let me share my screen. Okay, let me see. I hope this is it.
Yep.
Can you
It's
see my
coming.
MATLAB?
Yep, we see
Okay,
it.
perfect. I have if you see anything else, I have a lot of tabs open right now. So that's why.
That's
Can
okay.
can you see my MATLAB still?
Yep, we see
Okay,
it.
perfect. So this program in a nutshell, it works to create a visual, which will be shown as a GUI window or a graphical user interface into the intertemporal choices consumers face in regards to their spending habits today and in the future, given tax and interest rates. So Lauren was kind of explaining a little bit before. It's fairly similar to her program in the way of creating a tax slider in regards to taxes and interest rates. But just to kind of build off of that, this idea of intertemporal choice reflect the decisions that involve trade-offs between the present and the future. So it builds on the theoretical aspect of intertemporal choice theory in the aspect of consumer spending today versus saving for tomorrow and what influences those choices. Um, so when running the file, so the code itself really starts on line 5 and on. So lines 5 to 6, it creates and simply sets up the structure of the GUI figure. And it creates a window that builds upon later codes, which will be shown in later lines. And then it creates the name, the title, as well as the position. So how it appears, its width from left, bottom, left, right, bottom, width, height, etc. And then
That's the
online,
tricky part, right, Karina?
yeah,
So if you
yeah,
modify that, everything collapses. So
yeah.
that's the tricky part of doing this type of things, guys.
Yeah, because I remember when I first copied and pasted, it didn't go correctly, and then there was an error that kept happening. I couldn't figure out what it was. And then I had to create a new M file, and I finally figured out it was the position that kept messing
Yes.
up the angle and the view. So very
Exactly.
important for running this file. Then you had the tax slider, and it basically just sets up the positions, its limits, the value. And this is really the first core part of the GUI window. So it has its positions and its limits. So limits are from 0 to 50%, and the value of the tax starts at 20%. And then it creates the text, the titles, as well as, again, the position. And then you have the interest slider at line 17, and it's kind of the same thing as tax sliders in lines 9 to 15. So you have the position again, the limits, the value, titles, etc. And then for the interest rate label, you start having like the text labels for the interest rate itself, and then you have the different axes that come up with the graph. So the position, tag, and the different variables that are named in there as well. And then from lines 28 to 32, you have the different savings labels, the consumption 1 labels, consumption 2 labels. So current consumption regards to future consumption, as well as the utility, which will be a major part in the function later on. And up to this point, we're simply setting up the visual to make it as straightforward to understand as possible. And then when you have the callback function, which updates simulation, which ultimately allows MATLAB to call back when a specific change occurs within the function. So because users keep changing the tax value or the interest value, it allows MATLAB to kind of refer to the original structure of the graph and the slider and the GUI function to figure out the different values in regard to these changing rates. And here we add actual values to the function or to the visual. So you have interest rate, income today, which starts at 100. And then you have your beta, which is 0.95, which refers to the discount rate or the value of future consumption. And then tau and R, as Lauren was describing before, it's the slider values, and it converts the percent, excuse me, by dividing by 10, it converts the percent rates to decimals, which makes it easier to kind of read and navigate. And then we define the utility function, which again is a major part of this whole function. So you have the log, which is consumption today. And then you have the log 1 plus R, which is the future consumption. And then you have the different labels. And within this economic model, the use of log kind of captures the law of the diminishing return. Hold on, sorry. Excuse me. Of the diminishing utility. And then when consumption increases, utility also increases at a decreasing rate. Sorry. Sorry about that. So that basically means like with every additional unit of consumption, there's less utility. So for example, if you have $1, it increases $2, there's a greater value to the dollar increase. But if you have $100 and then it increases to 101, it increases by the same rate, but it's less of an impact with this dollar increase. So that's a major part of this function, the law of diminishing utility. And then, as I said before, utility is a big part of this function. And it refers to this idea that utility itself is not linear. So utility diminishes from extra consumption, which directly leads to consumers to consume across periods. And then also when you think about it, if utility were linear, the solutions would be one of two extremes. So you would either save all your income or consume it all at once, which obviously we know it's not plausible. So it kind of creates this kind of realistic standard and a realistic graph to analyze this part. And then you have the saving limit. So it creates the, sorry, I lost my spot. Yeah, so you have the saving labels. And then again, consumption 1, consumption 2, and then the utility. And then you have the optimal savings as well. Excuse me. Then you have the optimal savings as well, which finds the value of savings that minimizes the negative utility function. And it keeps savings kind of in bounds, which keeps savings more than income, which creates a savings more than income rate that to avoid implausible outcomes and more realistic standards. And then to compute the consumption rate, we have opt underscore C1. And then future consumption is opt underscore C2. And then to find this level of utility, we have max U negative utility times opt S. This ultimately converts utility from a negative to a positive value, as utility can never be negative. And then we have the text labels. So it converts the abbreviations, excuse me, into actual readable text. So you have the saving label, the C1 label, the C2 label, as well as the utility label. And then we start to really build our 3D model as well. So we create the values for the utility surface, and it combines the C1 values and the C2 values, and it creates evenly spaced kind of sections as well. And then we use line space also to create these evenly spaced consumption values, so they're not really on top of one another. And then we start to build the grid. So we lay out all possible created combinations. And then we calculate the utility at every point. So it creates this 3D utility graph. So we have C1, C2, U, and kind of just setting up this graph and what it would look like as well. And then we plot the optimal point with op C1, C2, max U. And then we also label this point as red to represent the optimal choice of the consumer. And this was kind of mentioned in Lauren's explanation as well. And then we have the labeling the graphs, X, Y, and Z. And it sets the view, this line 69 kind of sets the view of this angle for the 3D graph. So you have the axes, the horizontal rotation, and the vertical view. So really kind of creating that real visual into what this would look like. And then again, going back to this update simulation command, it allows for these changing values to be demonstrated within the new figure and the new graph. And I actually, if I run it here, let me see if it gives me the visual right away. Yeah. So here we have the intertemporal. Can you see the graph or no?
No.
Okay.
No.
Let me do this. Maybe, hopefully.
I think you need to share again. Yeah, perfect.
Okay, perfect. So then we have the intertemporal policy simulator. So as you can see, the more you shift it, it'll keep changing. So first you have, originally I think it was 15%, and then I think it was 5 or 20, I think it was somewhere around this point. So you have the red dot here, which again represents the utility maximizing combination, or the point that produces the highest utility for the consumer themselves. And then every other point within this section would be the different possible consumption bundles that represent a consumer spending versus their saving habits. And yeah, so it basically, in a nutshell, analyzes how tax and interest rates influence the way income is used and how it is spent versus how it is saved or allocated to different portions of one's finances.
Yes, and guys, what is interesting to understand here is that every time that you move the sliders, what MATLAB does is captures the numbers, optimizes, and basically changes the figure and changes everything.
Mm-hmm.
You see that it is more effective than you yourself doing one by one. You see, because you can do this without the UI, the GUI.
Yeah.
Okay, but the GUI is extremely useful for analysis, guys. If you want to see policy recommendations, I told you, or any type of simulations, the UI works. So that's why I stress this a lot for you guys. Okay?
Yeah.
Makes sense, guys. Questions? Okay, guys, please don't remember at the end of the class, send me the files that you have used. I need to test them again and see if they work with me. And then I will share with everyone.
Okay.
Okay, Karina, perfect.
Yeah.
Thank you very much. So now we have the log exponential function, right? Bafana?
Yes.
Hey,
Hi,
Bafana,
bro.
how are you?
How are you?
Good.
Good. So I'll be presenting on the ISLM dynamic app.
Yeah.
So let me just share my screen. Can you see the screen?
Yep, perfect.
Okay. So the ISLM model. So I just created a few formulas that just to give context before the code. Okay. Okay, so the ISLM model contains the IS curve and the LM curve. So the IS curve is it's basically the equilibrium in the goods market, and then the LM curve is the equilibrium. It captures all the equilibrium in the monetary market. So the IS curve we have here, Y is equal to C, which is consumption plus investment. Investment is a function of the real interest rate plus government spending. And both the consumption and the investment are broken down. So consumption is broken down into autonomous consumption, which is C0, plus we have the marginal propensity to consume multiplied by disposable income, which is our income Y minus taxes. And then for the investment is just autonomous investment minus this B multiplied by the real interest rate. So this B is how sensitive investment is to changes in the real interest rate. So substituting both of these into the original Y equation, this one will yield all this, and then you solve for R, which will give us the real interest rate of the IS curve, which is this equation here.
Perfect.
And then the LM curve is also, this is the money demand, which is equal to K multiplied by income minus H multiplied by R. So this K is how sensitive the money demand is to changes in income or output. And then H is how sensitive money demand is to changes in the real interest rate. So in the money market, equilibrium is achieved when the money demand is equal to the money supply. The money supply is given by this is the real money supply, P being the price level. So the money supply is equal to the money demand. And then solving for R here will yield this equation. So this is the real interest rate in the money market. And then we have the equilibrium. So the overall equilibrium in the economy will happen or will occur at the point when the IS curve intersects the LM curve. That will give us I think the general equilibrium in the economy. And so this happens if the real interest rate in the goods market is equal to the real interest rate in the monetary market. Or put another way, if the difference between the two interest rates is zero, that's when we have the general equilibrium in the economy.
Perfect.
Okay, so I'll go to the code now. Can you see the code?
Yep.
Okay. So this is the ISLM model with shocks and dynamic policy simulation. So it basically creates a user interface wherein you can change the values for the government spending, for the money for the money, the level of money, and the interest rate, just to see how changes in the general equilibrium become. So this is the properties. This is just to create the user interface, and then we have these properties. So here I've given labels to these properties, C0 being the autonomous consumption, and then C1, the marginal propensity to consume, I0, autonomous investment. So these are the parameters that I described in the model that I showed you in the PowerPoint presentation.
Perfect.
And then P here being the price level, and then the time step, when you go further into the code, you'll see it's set to 10 steps. So when I change any value, and then the shock will give me 10 steps, so there will be 10 iterations. And so this function from line 40, this will compute the equilibrium levels of output, of the real interest rate, of the real interest rate in the IS curve, and the real interest rate in the money market or the LM curve. And then these equations, RIS and RLM, are the equations I showed you in the PowerPoint slide. And then this valid is just to make sure that the values that we get are plausible values, that they exist in a way. And then the absolute value of RIS and RLM, that's just to make sure that this program makes sense, that we don't get interest rates that are above 100%. And then so this try and catch, this is also to try and avoid errors. So this catch function or this catch command will only take place, or it will run if there are errors in the equilibrium output or interest rate. So if it happens that we don't find the equilibrium output or the equilibrium interest rate, this catch function will take this command will take place, will come to play, but it won't affect how the program runs. The program will still run. So I think that's why they are included here. And then the second function here is just for the plot. So as it says, updates the plot with government spending, the tax, and the money level for different properties that we defined above. And then see, it says that if the equilibrium interest rate exists, then the plot will continue. So this will be plotted, and then else it will. This is sort of like an error in a way to say that the equilibrium is not found. And then these are just the titles of the plots and all that. And then the results are stored here. And then this is another function that runs the
simulations, right?
runs the simulation, yes. So it's whenever I change the simulation keeps on running. And then as I mentioned earlier, this will run for 10 steps. So if I change one value, there'll be 10 iterations, and then 10 iterations before the next equilibrium value. And then this on run, this is another function. So this on reset. So this is on run. On the simulator, there's a run button that you press once after changing the values, and then this is for that. And then this function is for the reset. So if I ran the code or if I change something and I want to go back to the initial equilibrium, this is the function that makes sure that ensures that happens, that I go back to the initial equilibrium. And then on export, there's also like an option to export this to a CSV file. So you can export your iterations to a CSV file. And then these are just, these are for the components. This is the function for the components. And so I'll just run the whole function to see.
Yeah, let's do it.
Yeah. Okay, I'm not sure. Do you see the?
No, we don't see anything.
Okay, let me just try to share it. Okay, can you see it now?
Yes,
Like
perfect.
enlarge.
Yep.
Okay, so now this is the initial equilibrium in the economy where the interest rate is 3.3% and the output or the income is 1,133. So you can either use this you can shift here, or you can go to the shock and just choose whether you want to increase the government spending, decrease taxes, or increase the money supply. So I'll just increase the the government spending and then run shock. So you'll see that the blue line, which is the IS curve, is moving upwards. I'm not sure if you saw that.
Yeah, we saw that.
And then, so this is the new equilibrium now, given the shock of the increase in government spending. And then you can also increase the money supply or increase the level of money, which will affect the LM curve, which is the rate dotted line. And if I run the shock, it keeps going down. And then this is the new equilibrium with 2% interest rate and 1,200 output or income. And I can also change here if I like to, and then it will do the same thing. Then if I want to go back to the initial equilibrium, press the reset button, and then it takes us back to the 3.3% and the 1,133. So yes.
And also you can export into CSV, right? You're using
yes,
write
yes.
table, right?
Yes, we can export to CSV. So now the issue with this, Prof, I couldn't find the CSV file.
Yes.
when I went to my the file manager. So I'm not sure what the issue might be with that.
Yeah, let me
But
check.
it
Once you
does
send
say
me, yeah, because it is ported to, so you
okay.
have it, admin. Oh,
Yes.
it tells you where it is. It is users,
Yeah.
admin, app that,
Yeah. So
yeah.
when I go to my admin, users admin, I don't see app
Oh,
data.
yes, it is a hidden one. I will show you how to do that. It's very simple. It's
Okay.
hidden. So you need to hide all the, because you have a bunch of directories that are hidden.
Oh, okay. Yes, yes,
And
yes.
then there is a way, I don't remember exactly, but just Google it and then unhide hidden directories, and then you're gonna see them. And then you just click.
Okay. So
Okay,
this,
perfect.
yeah, this exports to the CSV, and then that's pretty much all.
Yeah, perfect. Questions, guys? Thank you very much. So this is another way of doing apps, GUIs, that you can do shocks, you can do a lot of things. It's very interesting, okay? And then you can see what is the impact on the IS and LM functions. Okay, thank you very much, Bafana. Thank you,
You're
Karina.
welcome, bro.
Thank you.
Thank you.
Okay, so we go now with Siki and Bhavya.
Hi, I'm going to share my screen.
Yes, please go ahead.
Mm,
Yeah, it's coming.
okay, this one.
Yep,
Yeah.
perfect. So you're
Uh,
talking about what is that?
portfolio
Portfolio optimizer.
optimizer. Yeah.
Yep, perfect.
Yeah. Today our group will introduce advanced portfolio optimizer function, which can be used to do some portfolio risk analysis, in the reality. And first, I will introduce what this function does in general, and then I will run the entire functions and introduce some important code parts according to the result, because this code have 400 lines, so
Yes.
I cannot run it side by line. Oh, okay. So first, in general, this function did four things. First, it computes the returns of several stocks, and then it generates it generates thousands of random portfolio based on the returns of these stocks. And thirdly, it identified the optimal portfolio using two methods, the Sharpe ratio maximization and the variance minimization. I think the portfolio identified by the variance minimization is suitable for the risk-averse investors who care most about the risk, who want to have the lowest risk. But the portfolio identified by the Sharpe ratio maximization is suitable for the investors who want a best return per unit of the risk. I think this is why this function introduced two methods to identify the optimal functions. And finally, this function also runs some risk analysis, like value at risk, and beta calculation, and also like sorry,
Yeah, Monte Carlo
Monte
simulations.
Carlo simulation
Right.
of the growth path. Okay, so let me run this entire code. Sorry, wait a minute. I can't see the entire picture. Oh, can you see it?
No, you need to, I think, share it
Mm,
again.
okay. Oh, okay, I see.
It might be in a different window, so you would have to share like your entire screen instead of just the window.
Okay.
Yes, here we see it.
Uh, sorry, wait a minute, but I can't see it. Where it is.
Not complete. So it's half the graph.
Uh, maybe because I use an external display. Let me try to
Yeah, take your time.
disconnect it. Ah,
Yes, now it's perfect.
Yeah, we can see it now.
sorry, I still cannot see it. Oh, yeah, I can see it now. Okay, but first let's focus on the here. Let's focus on the calculation result first. Yeah, here.
Guys, by the way, this data set comes from Google, sorry, Yahoo Finance. Very simple, straightforward data. Got it? And if you take a look to the data, you can see is the start date is 2025-21 and 2026-05-21. The data names are Apple, Microsoft, Google, Amazon, Tesla, NVIDIA. And we have the index, the benchmark here is PY. Got it? And it's data just collected from Yahoo Finance. Yeah, please continue.
Okay. So actually the first 100 lines are also about how to import the data. So I just mentioned some important variable I think here. I think the first very important variable is the benchmark ticker. Because when calculating the maximum Sharpe ratio, we need to have a benchmark, which, sorry. Okay, which has a risk-free rate. So here we use the SPY as the benchmark ticker and the others as the normal tickers. And here we set the risk-free free rate and the numbers of the portfolios and the initial investment. These two variables will be used in the risk analysis part. So when I use it, I will mention it again.
Perfect.
Besides, I think there is still another important variable is the stock returns. This is simply calculated by this formula, which is use the today's price to minus yesterday's price and divided it by the yesterday's price. But in the first place, we place not a number first because the first date doesn't have previous price. So we placed a placeholder here. But when we use it to do analysis, we will automatically delete it by deleting the missing rows. And here's come to the calculation of the mean and the covariance of the returns. These two variables will be also used in calculating the Sharpe ratio. Okay, I think I should first give the definition of Sharpe ratio. Here is the formula of Sharpe ratio, which is use the portfolio returns minus the risk-free rate and then divided it by the portfolio risk. The portfolio risk is just the covariance we calculated in the last part here, but times it with the trading days. And this is the Sharpe ratio we will use in the entire
Yeah, the portfolio risk is not the covariance. It's based on the covariance, but what it does is a quadratic function. So it takes all the elements on the main diagonal. Remember, the main diagonal represents exactly the diagonal represents the variances. Got it? And then that's why you take the square root just to take it the variance. You transform that into the covariance. Makes sense to everyone, guys? You remember this variance covariance matrix that we created? That is simply a quadratic function. If you see, it's weights times the covariance times weights again. Okay, so what you're doing is you're multiplying the diagonal by the weights square because the variance is square. And once you sum them, you simply take the square root to take the standard error, the standard deviation, sorry. Yeah, this is good. Thank you, Siki. Let's continue.
Okay. Okay, so let's come to the next part. We first find the position where the maximum occurs, and then put the values here into the max Sharpe returns. accordingly, we also put the risk and weight here. And here is the result we got for the Max Sharp portfolio. And here is the weight for different tickers. And here is the returns and risk and Sharp ratio for this optimization.
Wow, 31% in Apple. Yeah, that makes sense. 1% in Tesla and 8% on Nvidia.
Yeah.
Yeah, interesting. Yeah, because it is taking Nvidia, this is 2025. It's the last year. No, it's 2025. It's 1 year of data. Yeah, can be. If we update this data, guys, this is going to dramatically change for sure because Nvidia is going to be the leading entity and Apple is not going to be so good now. Apple is going down. Yep, but great. So that's why you can do this daily. Do you agree? So you can more or less see the portfolio composition daily. And of course, you don't rebalance your portfolio daily, but you can have an idea how the portfolio is behaving. Yep. Thank you, Siki. Let's continue.
Okay. And the second method is to minimize the variance. Actually, compared to maximize the Sharp ratio, the variance minimization will give a lower risk. We can also see this result here.
Yeah.
Sorry, here. Here is the risk we get from the variance maximization, but here is the risk we got from the Sharp ratio maximization.
Yeah.
Yeah. Okay. Oh, okay. So now let's move to the pictures.
Yep.
Okay.
So guys, if you have seen portfolio optimization, the Markowitz, we always draw the portfolio frontier. We draw the portfolio frontier, so you can see more or less that it has this shape. Got it? The minimum variance portfolio, and then you have your maximum Sharp. That should be the maximum Sharp should be the one that if you put the risk-free aligned to the portfolio optimal set to the POS is the intersection. Yep.
Okay. This picture mainly shows the distribution of 5,000 random portfolios. I think this is very interesting that instead of using a fixed color, this function use different color to represent the different portfolio. For example, from bottom to top, as the return grows, the color change from blue to yellow. And the blue star is the minimum variance portfolio, and the red star is the portfolio got from the Sharp ratio maximization. Both of them should lie on the efficient frontier. But actually, this picture didn't draw the entire efficient frontier, I think.
No, it doesn't. But you more or less see the graph. That's right. Yep.
Oh, sorry.
Yeah, that's perfect. Okay, let's move.
Okay. So the second picture shows the correlation between different stocks. As we can see, if we choose two stocks who has relatively low correlation, maybe we can use the combination of them to reduce the risk volatility. But as we can see, most of the stocks have a relatively low correlation. They are both less than 0.8. Okay, the third one. Sorry. Before showing the picture 3, there is still 2 calculations we need to mention. So let's go back to the result here. Wait. Oh, here. The first one is the value at risk. Yeah, it is used to calculate how much we can lose with a given confidence level. And the confidence level we set here is 0.75,
No, 95. Yeah.
95. And use this function, we can calculate the value at risk. Finally, we got the result here. This means 90% on 90% 5 days, the loss we have is below the, let me see, 1.6%. So I think it is acceptable.
Yeah.
And the second calculation is beta. It measures how a stock moves relative to the benchmark. And the formula is to use the covariance of the stock and the benchmark and divide it by the variance of benchmark.
Mhm.
The result here, we can see. I think maybe here we didn't use the correct benchmark, right?
Yeah, because it's moving like with the market. Interesting.
Yeah.
Yeah. But all of them are defensive. But remember, beta can be larger than 1 also. So it's limitless. It's positive but limitless. 1 is possible.
It's
1
possible.
simply means that moves exactly the same as the market. But
Mm,
it's very strange to have a 1 sharp, no? Yeah. But that's what it means. All the other ones means, for example, the first one, 14%. The Apple, it implies that if the market moves 1%, Apple is going to move positive also, but only 0.14%. Yeah. Yeah, and this comes also from the model, guys, the cap, sorry, this is well, yeah, actually, this is the CAPM model. So the beta is simply the covariance of the asset versus the market divided by the variance of the market. That's the one.
that's
Yes,
one.
that's the one. Yeah. And the beta simply tell you how risky your position is with respect to the market. Okay, less than value is defensive, more than 1 is equal to the market, and more than 1 is offensive or aggressive, they call it. Yeah, so none of them are aggressive here in this, according to these results. Great. And then you have the Excel. So you export this to Excel.
Yes, I think.
Yeah.
But I didn't open it.
No, but that's okay. But you are able. This program is already able to export to Excel. Okay, guys. So this is a beautiful program. I use it just to see portfolio rebalancing. It's extremely simple. You just get the new data from Google, update it, run, and then you get it. It's very, very simple. It's very insightful. Okay, let's continue. Yeah.
Sorry, we said we still have 2 more pictures. This one is actually the distribution of portfolio of daily returns of portfolio, and this bright line is the value at risk we just calculated.
Mhm.
The picture 3 is the Monte Carlo portfolio simulation. This is divided by 1,000 simulation,
Mhm.
and which start and both. Yeah, and all of them start from the same initial investment, which is 1,000 we set in the very beginning. We can see all of them have a very strong growth in
Right.
growth in trend. Yeah. And this is the actual portfolio grid test. It is very similar to what we got from the simulation.
But that one is only made by the best portfolio, right?
Yeah.
Yeah. Well, that's good. It's 80% in how long? 1 year.
Yeah, 1 year.
Yeah. Tested. So you just take a look to portfolio. It's for fun, guys. If you take a look just go and create an account on Robinhood or Interactive Brokers, just open $100 and you can trade and you can create portfolios and then you can basically see how this works. You don't lose a lot of money, but it helps you train yourselves on trading. It's a very good exercise. And you have the program to do that now. Thank you very much, Siki. And where's your colleague? You did this with Babja.
I- Yeah, I'm going to talk about the part of the program which is where the users can change. So, but
Yeah,
Siki will
perfect.
show the code and I will talk about the code. So
Yeah.
first we could change the tickers within the code. If we go right on the top. So the tickers are something we can change. Which assets, so this changes which assets are included in the portfolio and which are not included. Then we can also change the benchmark of in this model, which is here the ticker is SPY. This affects basically the beta calculations. Represents basically the benchmark of the market. We can also change, of course, the time period. As you can see, here we've picked to be like 1 year, but it can definitely be more or less as we require. This would pull the data based on what time period we set there. With changing these dates can also change the return and the risk estimates in this model. Then we can also change the risk-free rate, which is basically right here, we've set it to like 0.3, but we could set it to higher or lower, which will affect the Sharpe ratio. And it will basically a higher risk-free rate, which makes it harder for a portfolio to look attractive, obviously. And then we can also change the number of portfolios. So here we have picked, for example, in this model, 5,000, but we can obviously change it more or less. More portfolios will give you a better search of possible weight, but it will take more time to run the code. We can also take initial investment. This is also something we can change. It will change the dollar value, which is a dollar value in the Monte Carlo and portfolio growth plots, as we just saw. And I'm also going to, I have slides also, but before I go to the slides, I want to talk about like one of the limitations that we have in the model, and the rest I will talk about in the slides without the code.
Yep.
But Siki, if you could show the random return in the code, which is mu plus sigma multiplied by a random variable. This is oh, there it is. It's line 270, I think. If you go down.
No,
If you go
yeah. Yeah.
the opposite, yeah. So yeah, just below a little that's it. So it's line 271. This is basically one of the limitations of the model. But basically the Monte Carlo simulation assumes that the daily returns are normally distributed. But markets may not behave normally distributed, but markets may not behave normally always. So that is a limitation of this model that we can say there is. And before we move to the slides, I also want to talk about the Sharpe ratio, which is portfolio return minus risk-free rate. Yes. Yes. So this is the portfolio that gives the best risk-adjusted return. So basically what this says is which portfolio would give us the highest return, rather but also in highest return and also best return per unit of risk. Okay, so I will now share my slides.
Guys, before you go there, there is one thing that you can do in this program, and it's straightforward. Because what we're doing here, guys, is we're doing, I think, 5,000 portfolios and then trying to select from those 5,000, right? So we're doing one by one. So instead of doing the one by one, what you can do is you can do an F-min search, for example, because everything is formulas, okay? So that model can be improved by using F-min search. So if someone wants to do part of the project for the final project you're going to be working on, this is one option that's very interesting. Okay, Babja, let's go. Oh, yeah, good. So you need to share with me all this at the end of the class, okay?
Yes.
You can continue. Yep.
So this is what we talked about in the codes
Yep.
earlier, which we can change. And now I'll be talking about the limitations of the model. So one of the biggest limitations of the model is its historical returns, which are basically assuming that the returns that took place, it assumes the past year's returns are useful for predicting the future, which may not hold during shocks in the economy, any positive or negative earning surprises or any changes within the economy, any regime changes. It also assumes that the portfolio is not the model uses random portfolio weights, which are not a formal optimization solver. So
Yeah,
the
that's why
maximum,
F-min search can help you better.
so the maximum Sharpe ratio, which is portfolio is the best among, which would be the best among 5,000 portfolios, which might not necessarily be always optimum. Then the model also assumes that returns are stable, and it uses mean and standard deviation. But real stock returns can be skewed, have tails, and have extreme losses, which is basically also known as on paper tail risk. Then there's also transaction costs, taxes, liquidity, short selling, other costs, rebalancing costs, and other investor constraints, which the model it currently doesn't include. Then there is also, so now I'll be talking about what the main intuition of this model is. The main intuition of this model is it is based on modern portfolio theory, which is also the Markowitz portfolio theory. And the basic idea is that investors care about return, and they also care about risk. Return is the expected gain from the portfolio, while risk is measured by volatility and standard deviation. And the important intuition is that portfolio risk is not just the average risk of the stocks, but it also depends on how the stocks move together. That is why the code calculates a covariance matrix and a correlation matrix. If we can go back and look at it at the end of this slide. So if there's two stocks that are not perfectly correlated, then combining them can reduce the overall risk of the portfolio. So, which is basically also how investors diversify their portfolio is one of the ways that they do it. The efficiency frontier, which was the Markowitz efficiency frontier we saw in the graph before, shows us the trade-off between the risk and the return. And some portfolios have low return and high return, which are inefficient. And then the best portfolios either give high return for the same risk or low risk for the same return. And then we already talked about the Sharpe ratio. The minimum variance portfolio would have essentially the lowest risk, and maximum Sharpe portfolio is the portfolio that gives the best risk-adjusted return. So what comes next in this model is once the model finds the best portfolio weights for like the initial 1,000 and then total 5,000 portfolios that we picked, it uses these weights to simulate future portfolio paths, estimate value at risk, the beta of the portfolios, and how the optimized portfolio should have basically grown over time, which is the last graph that we saw that Siki shared. So the model gives a portfolio framework. Any questions? That should basically is all that we
Yeah, that's great. So two things that you can do here, guys, to improve it. You know, when you do this in your work, not necessarily for this class, but one of them is F-min search, because the 5,000 simulations, if you add more 10 names, it's gonna be very heavy on MATLAB. F-min search. And the second thing that the people do normally is something that is called in-sample, out-sample. So you train your model, let's say 1 year is too little. Let's say 2 years. We train the model for 1 year, and then we start forecasting for the next, let's say 10 days. Then you adjust the model, change the parameters, and see how this works. Now, in terms of the transaction cost, it's very simple to adjust. The transaction costs are normally a fixed number per share. So you can go. I think it has a beautiful transaction cost structure, interactive brokers. So you can see they are fixed numbers per share. So you can simply add some multiplicative number that simply deducts from your money. Taxes, you need to be very, very interesting is that if you buy, remember that is taxable income on capital gains only. So if you buy now and then you don't sell until several years, you're never going to be taxed, okay? But if you buy and sell, buy and sell, buy and sell, so at the end of the day, what you do is very simple. The taxes don't add up to is quarterly tax or annual tax. So let's assume quarterly tax. What you do is you simply compute. I started at 100, now I have 120. From here, I deduct 15%, and then you continue trading. So they are very easy changes, okay, that you can improve your model. So if you can do F-min search, include a fixed number transaction cost, and include taxes, quarterly taxes or annual taxes, that can help you better improve your model. And let me tell you, sometimes the models just by taxes and fixed costs or transaction costs, the profitability decreases significantly. It's logic, okay? But good. Thank you very much. It was a very good presentation. Thank you. Oh, no, we have one more group. Yes.
Yeah,
Jason and Alfredo. Yes. Okay.
Okay.
Thank you.
Thanks, radio.
Yep. Also, we have one more group. Okay, this is great.
Yeah.
Yep.
Okay. So yeah, as you saw on the email, we'll be focusing on the multi-stock portfolio analyzer. So we just have a quick slide just to break down all of the terms before, and then afterward at the end, I'll go through the MATLAB code as well, just so you can see it as well in real time. So let's make sure we go. All right, so real quick with the agenda, quick theoretical institution, what the model does, main variables, user can change, as well as limitations. So these are just the information you might need to know beforehand just to understand the model. So just in case anyone's not as aware yet, really quick, a portfolio is just the collection of assets put together by an investor. So each stock is assigned a weight representing how much total investment goes into it towards this specific portfolio. And one thing that monitors, which will be addressed in the model as well, is that the weight must always sum to 1%, to 1 or 100%. as shown as it from the model here with Apple, Microsoft, Google, and Tesla all
Yeah.
equaling 100% then.
Yes, but remember, guys, this is very interesting. The sum of the portfolios needs to be equal to one. This implies that you can have short sales. Agree? So you can have some negative weights. Okay.
Yeah, I think definitely with the negative, and then but yeah, once you go over in any of it, then the portfolio no longer qualifies.
Right.
And so going with that, so there's some key financial concepts as well to discuss. So first is just the daily returns. It's just simply the stock's price on a day-to-day change, see how it changes. And this is usually expressed in percentages. And as you can see, the formula is just today's price minus the price yesterday divided by the price of yesterday. And then following this is the annualized return. So this one is just where you scale it up to a year, multiplying it by around 252, which is the average number of trading days in a year. And this gives us the more meaningful number to compare against. And then following this as well, is volatility, measuring how much returns fluctuate and essentially the risk of the portfolio. So this just shows like how much risk does this specific portfolio or these types of stocks have in regards to returns and possible risk. And this correlates as well with Sharpe ratio, which was already briefly discussed by the other group as well. So I won't go too much into it, but again, it just measures the return earned based on the risk that you're taking. And they mentioned the formula a while ago of annualized return divided by annualized volatility. And all of this connected goes to correlation, which just measures how the two stocks move relative to one another. So it can range from -1, which means that they're completely opposite stocks from one another, or +1, which shows that they're quite identical in regards to the field of work that they present.
Right, guys. When it's a -1, if you find a -1, so you're the king of the jungle, right? Because basically you can disappear your risk. Okay, and if it's 1, you're doing nothing. So remember that.
Hmm.
Yep.
Yeah, usually from what I understand, people you try to go closer to -1 because they really want a more diversified portfolio for the
Yeah.
most part.
Yes, but it's very tricky to find, and even a negative correlation between two assets is very tricky. BTCs were at a given point in time negative with a SP 500, but it lasted less than 3-4 months. Everything
Yeah,
else now even crypto is very closely related to the markets, right? Yep. Let's continue. Perfect.
perfect. But yeah, if you guys have any more questions about these concepts moving forward, feel free to just raise your hand. But now I'll just connect this to the model we'll be discussing as well. So this is an overview. This is just a MATLAB-based portfolio analyzer that takes historical stock data and produces a full financial analysis. So it runs through 5 primary stages. So first, obviously, it loads the data from the Excel files or from the Yahoo Finance if that's where you're getting the data from. Compute metrics as well, calculate the return, moving averages, as well as the overall performance of the portfolio. And from once they have all of the metrics together, that's when it begins the analysis of the portfolio itself, building a correlation matrix, which we'll see in the figures laterwards. And afterwards from this, it will just do the two primary things in the end, which is just to generate charts for individual stocks as well as portfolio growth and return distribution. And this will also eventually be exported to a structured Excel report. I haven't gotten to see the Excel report because I had the same problem as Bafana where I couldn't find the location.
Yes.
I'll
Yes.
just wait to see how that goes later. Yeah.
Yeah. You just take a look and then just Google how to unhide hidden directories.
Yeah. Okay.
Yeah,
So I'll try
because
to
you,
look for
you
that
don't
one.
see them. They are there, but you need to unhide them. Yeah. Let's continue. This is good.
Yeah. And then yeah, following this, just some data loading and computation, some things to take note of what the model's really doing. So for data loading, it loops through each ticker one by one, builds and it eventually builds a file name dynamically using the ticker name and date range. And from here, it reads the Excel files from the local directory using the read table functions. And from here, it results into the daily returns, which again was computed during the formula shared a while ago. And the first row is set to none since there's also no previous price to compare to for the daily returns. For moving averages, it does two primary moving averages of 20 days and 50 days as well. So this just showcases the short-term trend and the long-term trend of each individual stock. And as well, just uses this to compute the using move. It's computed using mob mean in the MATLAB for coding. And yeah, just to showcase both individually and as a portfolio the long-term investments. And real quick, just the outputs and visualizations that it presents for the charts regarding it. It'll show the individual stock charts for each company, showing it in the 20 and 50-day moving averages, the normalized price comparisons, as well as portfolio growth chart, which shows a $10,000 initial investment growth over time. And lastly, just a histogram showing all the spread of daily portfolio returns. And again, as mentioned a while ago, this will all be exported into an Excel file showcasing the price sheets, adjusted return sheets, summary sheets, portfolio sheets, as well as the correlation sheets for this one.
Fantastic. Yeah.
And for the variables that you'll be seeing later on, just so that you're aware of them already, it'll be tickers, weight, start date, end date, directory, and initial investments for the input variables. And so yeah, this is a quick breakdown of what exactly they'll be later on, just for your reference, as well as for the output variables and the computed ones. It will focus, as what I said a while ago, on a lot of returns. So it involves stock returns, portfolio returns, the matrix for this, annual return, as well as the variables discussed a while ago in volatility ratio, Sharpe ratio, correlation matrix, as well as the overall growth of the portfolio. So these are the variables you'll be seeing later on the model. We'll be discussing how they correlate to one another. But first, I'll be passing it to Jason just to share the capabilities of the model, what the user can change, as well as its limitations.
Jason?
Yes,
Oh, here
so
we go. Yep.
I'll be going over the oh, hold on, let me okay, so this model will allow users to analyze stock portfolios by changing the tickers, portfolio weights, Excel data files, moving average periods, investment amounts, and output settings, and it provides a visual and basic portfolio metric, including annual return, volatility, Sharpe ratio, correlation, and portfolio growth. And this model will have several limitations. It relies on manually prepared Excel files, hard-coded file paths, and file names. And it does not actually use the data input, does not align data by date, and does not optimize the portfolio. It is best used for a basic historical portfolio analysis tool, not as a forecasting model or investment recommendation system. So first, we'll be going over the what a user can change. So the first thing will be the stock tickers. So the users can basically change the model tickers. Like for example, the example I have here from Apple to Nvidia, but in this case, each ticker must have a matching Excel file available. So in the required file for this change to be applicable. And the second thing we could change is the portfolio weight. Like the example here, the percentage of a company of the portfolio, but it has to add up to 100% or one. If they do not, the model stops and returns an error message. And third will be the number of stocks. The user can analyze more or fewer stocks by changing the number and of the tickers and weights. Like, for example, you could change the weight to 0.4 for Apple, 0.35 for Microsoft, and 0.25 for Nvidia. And the number of weights must match the numbers of tickers. And data range too. So this model includes inputs for start date and end date. So the start date would be, for example, from 2025 May to 2026 May. In the current version, these data are not actually used to filter data. The model instead uses the hard-coded Excel file names that include the data range. This means that the user can change the data variables, but the results will not change unless the Excel file names and resource are also updated. And we could also move the average periods. The model currently calculates 20-day and 50-day moving averages. So we could change that to reflect 10 days, 30 days, or 100 moving day averages. We could also change initial investment amounts. This is pretty straightforward. So now the initial amount is 10,000. We could change that to another amount, however much we want, 50,000 or 100,000. And also histogram bins. The model shows the distribution of daily portfolio returns using 30 bins. That's what we have for the current model, and the user can increase or decrease the number of bins to make the chart more or less detailed. And now I'll be going some model limitations. So first will be the live data. There's no live data. Everything's pulled out from Yahoo Finance, and users must manually prepare Excel files before running. Hard-coded file path. So the directory path is fixed to one computer, and Any other users must manually update line 42 to match their own folder path before running. And third is the data inputs are not actually used. So the start date and end date do not control the analysis period. The model depends on Excel files with fixed names, and changing the dates does not change the data. And it also requires specific Excel formatting. So the Excel file must have correct file names, a sheet named clean data column, and a so yeah, basically if any columns are missing, then the model will fail. So, and there's also no file existence check. So though there's no error handling if an Excel file is missing, the program will simply stop with an error. And it does not align dates across stocks. So the model uses dates from the first stock only. If stocks have mismatched or missing trade days, the data may not line up correctly. And the model also only provides historical performance. So it does not forecast future returns or predict future stock prices, like I previously mentioned. And also, there's no portfolio optimization. The model only analyzes user-defined weights. It does not find the optimal allocation for highest return, lowest risk, or best Sharpe ratio. And the standard Sharpe ratio subtracts a risk-free rate. This model skips that step, making the Sharpe ratio slightly overstated. And the model uses simple percentage returns. Log returns are generally preferred in financial modeling as they are easier to aggregate over time. And annual return is calculated by multiplying average daily returns by 252. This does not fully account for compounding. A more advanced model would use CAGR. And the constant portfolio weights, the model assumes fixed weights throughout the entire period. It does not account for natural weight drift due to price changes over time. So there are also no transaction costs or taxes. So the model ignores real world costs like trading commission, bid ask spreads, taxes, and management fees. This may overstate actual performance. And there's also limited risk metrics. The model only computes return, volatility, and Sharpe ratio. It does not calculate drawdown, value at risk, beta, alpha, or Sortino ratio. And uses the model uses EVAL to read Excel files dynamically. This makes the code harder to debug and less secure than a direct read table command. And the output file may be overwritten. The model always exports to portfolio underline analysis. If the file already exists, it will be overwritten every time the model runs. And that will be all. And I think Alfredo will now take
Yep.
over
So yeah,
with
thanks
the
for
code.
that, Jason. So
Thank you.
yep. So now we'll be moving forward to the MATLAB version of this, just so you guys can see it as well in real time.
Yep,
So let
let's
me
do
just share
it.
my screen real quick. Okay, perfect. There. So just let me know. Just double checking, is the screen good to go with MATLAB already?
Yes.
Okay. And then so with this, so again, real quick breakdown of the features. It lets you upload data from Excel. This one downloaded from Yahoo Finance, as the data is not free anymore. It does a
That's the
multi
point, guys. Indeed, there is a MATLAB
Yeah,
command
it
that
does.
allows you to get directly to the Yahoo Finance, but you need to have a paid version of that. Before it was for academic uses, it was free, so you just get download in real time. It was very nice, but no, not anymore. You need to pay.
Yeah, like I'm pretty sure when I check the service, it's still there. It's just a paid service
It
now,
is. You need to
unfortunately.
pay. Yeah, you need to pay.
Yeah.
That's all. Okay, Alfredo,
But
let's
yeah,
continue.
again, it just does a portfolio analysis, and then it shares with you the correlation matrix and the risk matrix afterwards. So we'll do it section by section just so it's easy to follow a little bit. So
Yeah.
for the user inputs, it's just basically where everything needs to get configured before the model can properly run. So as shared a while ago, the ticker just holds the four stock symbols that we want to analyze. following by the weights of each one on the portfolio, as well as the date ranges we discussed a while ago. And then the validate weight section is just to ensure that, as you mentioned a while ago, the portfolio weight sums up to 1. As if it doesn't, then it would cause an error and it will be signified by the model. And then from there as well, initializing, which is line 35 to 42. So the number stock is set using the length tickers. So the loop knows how many iterations basically to run. And for the alt prices and return tables, they're just initially as empty tables that will eventually be populated during the loop. And following this, lastly, is just the directory. So this is just basically where all the files that they'll be uploading or getting data from, sorry, will be already uploaded, which is what I already did for this one. And then nextly, of course, is just to download the data loop. So this just causes the loop to run from 1 to the number of stocks, or for this one, it's going to be 4 iterations on each pass ticker. And so from here, the line 52 with the data name, this one just basically builds, especially for the date range, instead of it actually reflecting, it will just reflect more on the file name once you save it, which I did see in a notification. I just haven't got to see it in real time because I haven't found the file yet. But that's how it reflects the date range basically when you export it.
Yep.
And then lastly, next from this one should be the store just a close price for every, yep. So for this one, it's just to reiterate the condition that if I equals 1, then the condition 970 ensures that the date column is only saved once into all prices. Since when this happens, all stocks basically share the same trading dates. And following this, line 74 then eventually adds each stock's adjacent close column to the all prices using the ticker name as the column label. So what this eventually does is use instead of regular close because it just adjusts for the dividends as well as the stock splits, giving basically just a more accurate return calculation, just trying to take into account more variables. And then from here, with all of this data, we'll be moving on to computing the actual returns. So the variable, the diff data dot adjacent close, this just basically computes the day over day price change or for every row, dividing them all by the date of these adjacent close. It just gives the percentage change relative to the previous day's price. And from this, it's also important to note that the NaN on the first row, or NaN, sorry, on the first row, it is intentional as there's no prior date to compare against. So this is what they mark it as. And these returns get stored in a returns table under the ticker column name as well in the Excel sheet. And then following this one is just the moving averages, which computes a 20-day rolling average of the adjusted closing price at every point in time. MA20 captures short-term momentum, MA50 captures the long-term one. And then following this, it will just move on to the individual stock plot, which you can see here, which will reflect in one of the figures you'll see later on. And it will just basically just show for each stock inside the loop 4 separate chart windows, which just draws the price and both moving averages on the same axes as well. So this just keeps all the 3 lines on the same chart instead of replacing one another, just so that's easier for analyzing. And then following this in section 9, that's where we will be removing the NaN rows. So it just moves any rows in the return matrix that contains the NaN values. And this is just necessary because the first row of every stock returns has NaN. And leaving those in would cause the errors in the matrix multiplication that computes the overall return of the portfolio. And then moving on to the portfolio return, actually, it's the next step here. So this single line is just the core of the portfolio construction. So it multiplies the matrix of stock returns by the transposed weight vectors. And overall, just the result is just one singular column of the daily portfolio returns where each day's return is just the weighted average from all of the 4 stocks. And connecting this to the portfolio metrics, which will be right over there, perfect. So for this one, it just gives the average daily return. And like, as I mentioned a while ago, it multiplies it by 252 because this is just the number of trading days in a year. It doesn't follow the standard 365. And from here, it just gives the daily standard deviation, which is our measure of risk. And multiplying by square root of 252 analyzes it correctly, since basically for the standard deviation, this scale with the square root of time just allows you to divide annualized return by annualized volatility, which gives you the Sharpe ratio you're looking for. And then nextly from this one, it's just a display metric. So this one just prints the results directly to the command window as it shows the certain numbers, which I'll do when we run it. And then for the summary table moving after this, it just organizes the 3 metrics into a structured MATLAB table with labeled columns, just for you to see it a lot cleaner and for any visuals you might need for presentations. It just basically makes it into a more readable table format. Next from this, it will just create a correlation matrix here in the bottom. So this one just computes the pairwise correlation between all the 4 stocks together simultaneously. And the diagonal is always going to be 1 since every stock is always perfectly correlated with itself. And then from here, it will eventually convert the number of matrix into a labeled table using the ticker names as both the rows and column headers to just see how correlated each stock is going to be from one another. And then, of course, next one will just be the normalized price comparison. So it just extracts all the price columns, including the dates, and it divides it every row by the first row. So every stock starts at exactly 1 on day 1. So this just allows you for easier comparison instead of just different price ranges, making it hard to properly compare the different stocks. So this basically makes sure everyone starts at day 1 just for easier valuation. And then from here, it moves on to the portfolio growth, which just computes the cumulative product of daily returns, which hopefully should correctly handle compounding. And multiplying this as well converts this into the dollar term, starting from $10,000, which was the investment shown in the simulation. And from here, it'll just reflect the returns distribution afterwards. So the histogram bins the daily returns into 30 buckets and plots their frequency. This gives you just a visual picture, which we'll see later on, of the return distribution and how symmetric it is, as well as how fat the tails are, where most of the daily return clusters will be. So just the other visuals you would be needing. And eventually, in the end, oh, sorry, I wasn't moving the MATLAB with that. But in the end, it will just basically eventually create the export tables, and it should technically export all of it into one file, which, as I said a while ago, it did do. I just haven't been able to see it yet.
Perfect.
But let me just click run real quick, just so everyone can see what would happen to it. Oh, hold on, let me just move zoom out of the way. Okay. So we'll start first with the figures real quick. So figures 1, 2, 3, and 4, they are pretty much the same ones. They are just the individual stock charts per individual stock. So these ones just shows the adjusted close price alongside its 20 and 50-day moving averages over the full year for this one. And the price line just shows the raw day-to-day movement while the moving averages smooth it out just for better monitoring. And usually if you follow the 50 or the long-term one, if the current price chart is above it, usually it means a more bullish signal for the overall stock. So these are just the ones for figures 1, 2, 3, and 4. And then for figure 5, this is just the normalized stock price comparison. So this chart just basically pulls all of the 4 stocks on the same scale starting from 1 as we shared a while ago. So this is assuming that if everyone started in the same starting point, this is how overall they would be performing at this very moment. So yeah, as you can see, it shows a big difference as Google is a clear front runner, and then the other ones such as Microsoft, which are still very good front runners, are not as evident when you start from point day 1 for all of them.
Yeah.
And then the next figure is just figure 6, which is just portfolio growth over time. I believe we had one also a while ago. But yeah, it just basically shows that once you make an investment of $10,000 in this specific portfolio, how exactly is it predicted to perform over time based on the investments? And the last figure you will be seeing is just the return distribution histogram, which we stated a while ago. So this just basically shows how frequent the portfolio experienced different levels of daily returns over the year, any types of volatility. And ideally, you see a distribution that is centered slightly to the right of 0, meaning more positive days. However, that's usually not always the case. And excuse me. And ideally, it should be relatively tight, which just means that most return clusters are closer to 0 with few extreme outliers. And ideally with this one, a wide spread usually means higher volatility, and a narrow spread means more consistent returns. And just given these one, even though there's a few outliers, it's still pretty congested. It doesn't look like it's as volatile as a portfolio as others, I believe. But overall, this one does look pretty good. So those are just the 7 figures that you will be getting from this model. And then, as I said a while ago in the command window, um, it will reflect as well these numbers, which is just correlation matrices, as well as the expected annual return, volatility, and the overall Sharpe ratio.
Fantastic.
But yeah, it's pretty straightforward. That's pretty much all you
Yeah.
should be getting from the model.
Yeah. So let me tell you the story here. When I created these programs, this was the first one. The second one is the one that was presented by Siki and Bhavna. Is you optimize. In here, you simply have a portfolio, fixed portfolio. The next one is you optimize 5,000 runs. And the next one is to you guys, is you need to optimize this smartly with using F-mean search or whatever type of things. Got it? So I give you the first 2, the third one is yours if you want to implement that in your model. Okay, guys, perfect. Thank you very much for your work. It was really well prepared. I'm very happy. Please share all the information, the presentation, everything. It is very nice. Thank you very much. And so I need to divide you into groups, and we are going to start in the same order. So group 1, group 2. So I start with Lauren, Trevor, Bafana, Karina, Siki, Bavia, Jason, and Alfredo. Okay, it's 5 minutes. You can take a rest if you want, but I will call you very quickly. If you have an idea that is clear, it can take 1 minute. So just stay around. Got it? So I will stop the recording, guys. And remember what is next. Today, I give you, we talk for a couple of minutes. Next Wednesday, if you want to meet with me, you need to tell me. Okay, otherwise we don't have a class. You have 1 week, exactly 1 week to finish your project. So your project, please, guys, it is a nightmare. I receive hundreds of emails per day. So what I need from you, you need to send me your complete package, homeworks plus project plus everything, please, between 11 and 12 on Monday. Okay, 11 and 12. So be sure that you send me your packages between 11 and 12. Otherwise, it's gonna be a mess
AM
for
or
me.
PM?
AM.
Okay.
Before noon. Okay? Makes sense. You can have it prepared, but send it by 11 to 12, please. I will be aware of that and will be recording and saving and then analyzing later. Okay, guys? Perfect. So let me so I